$130. Serious. That's the number, per barrel, not a worst-case panic scenario invented by a blogger. That figure comes from Chatham House, one of the most respected geopolitical research institutions on the planet. And according to their analysis, it is where oil goes if this war continues at its current trajectory through the coming months. Size. So let's look at the real picture, clearly, without panic, but without the comfortable omissions either. I've spent time going through the primary research, not the summaries, not the op-eds, but the actual institutional analysis. Chatham House, Capital Economics, the IMF's scenario modeling, the Bank for International Settlements. These are not ideological sources. They are institutions whose entire credibility depends on being right, or at least on being honest about uncertainty. What they are saying right now deserves more attention than it is getting. Here is the thesis of this video, stated plainly. The scenario in which this war extends by several months does not produce a manageable slowdown. It produces a cascade, oil first, then European growth, then Chinese output, then a contraction that touches every economy connected to global trade. And the part that the mainstream coverage keeps leaving out is how those three shocks interact with each other. Let's start with oil, because oil is the transmission mechanism for everything else. Chatham House projects a price of $130 per barrel in the near term before a potential decline in the second half of the year. Curious. To understand why that number is so significant, you need to understand what it means structurally, not just at the pump. Every economy on Earth has an embedded oil price in everything it produces. When you buy a loaf of bread, you are buying diesel that ran the tractor, diesel that ran the truck, diesel that ran the heating in the storage facility. When you buy a shirt, you are buying energy used at every stage of its manufacturing chain. Size. Oil at $130 doesn't just make driving expensive. It raises the input cost of nearly every physical product on the planet simultaneously. The last time oil held above $120 for an extended period was in 2008, and again in 2011 and 2012. Thoughtful. In 2008, it contributed to a consumer squeeze that amplified what was already a Finan CL crisis. In 2011 and 2012, it was a persistent drag on growth in Europe during the early years of the sovereign debt crisis. Thoughtful. Those historical episodes give us a clear mechanical picture of what happens. Central banks face pressure to keep rates elevated to fight inflation driven by energy costs, even as the underlying economy is contracting. Size. That combination, inflation from above and weakness from below, is one of the most difficult environments any policymaker can face. And here is the part that gets underreported. The oil price shock of this scenario is not uniform. Countries with energy self-sufficiency, certain Gulf states, parts of the United States production base, Norway, absorb it differently than countries that import nearly all of their energy. Europe is in the second category. China is in the second category. Both of them are already in the Chatham House and Capital Economics scenarios, and the numbers from those institutions are striking. Size. Capital Economics is projecting Eurozone GDP growth of 0.5% under a scenario of sustained conflict and elevated energy prices. Let me give you a sense of what that means in practical terms. Curious. 0.5% growth for the Eurozone is not a recession by technical definition. A recession requires 2 consecutive quarters of negative growth. But it is growth so slow that it functions like a recession for most people. Live inside it. Business investment slows because margins are compressed. Hiring freezes because demand is uncertain. Government budgets come under pressure because tax revenues decline and social support costs rise. And critically, the Eurozone has very limited room to respond with additional fiscal stimulus because several of its member states, Italy, France, Greece, are already carrying debt levels that constrain their options. There is also a geographic and sectoral dimension that the headline number doesn't capture. Germany, which is the engine of the European economy, is specifically exposed to energy-intensive manufacturing. German industrial output has already been adjusting for several years to elevated energy costs following earlier supply disruptions. A further spike to $130 oil would fall on an industrial base that has already been under stress. Size. The resilience is thinner than it was in previous cycles. Think of it this way. Imagine you have been running for an hour and someone asks you to sprint the last mile. You can do it, but the cost is much higher than if they had asked you at the start. That is roughly the situation European industry is in right now. It is not broken, but the reserve capacity to absorb another major shock is reduced. The other European dynamic that rarely gets discussed in the financial press is the political dimension of an economic squeeze. When growth falls to near zero and energy bills remain elevated, the political pressures inside individual member states intensify. Curious, coalition governments become harder to maintain. Fiscal solidarity at the European level becomes more difficult to negotiate. The institutional mechanisms that held the Eurozone together during the 2010 to 2015 sovereign debt crisis required enormous political capital to operate. That capital is not infinite, and it is not automatically regenerated between crises. Now let's move to China, and this is where the analysis gets particularly important for anyone trying to understand the global picture. Capital Economics is projecting Chinese growth falling below 3% under the extended conflict scenario. For a country whose entire economic and political model has been built around delivering consistent growth, and whose legitimacy in the eyes of its population has been substantially tied to continued improvement in living standards, below 3% is not just an economic number. Concerned, it is a structural stress event. China's exposure to this scenario comes through multiple channels simultaneously. First, as a major oil importer, elevated energy prices directly compress the margins of its manufacturing sector. Second, if European growth falls to near zero, European demand for Chinese exports contracts, and Europe is one of China's largest trading partners. Third, if the conflict disrupts global shipping routes or introduces new sanctions architecture, the logistics costs of Chinese trade rise even before the demand side. Contracts, each of these three channels, would be manageable in isolation. Size. The challenge in the extended conflict scenario is that they arrive simultaneously, reinforcing each other in ways that are difficult to offset through domestic stimulus alone. China has used infrastructure investment as its primary counter-cyclical tool for years, but the return on that investment has diminished as the most productive projects have already been built, and the debt carried at the local government level has accumulated to the point where the People's Bank of China and the central government have explicitly acknowledged constraints on how much additional leverage can be responsibly deployed. Below 3% growth in China ripples outward in ways that are sometimes underestimated in Western financial analysis. Commodity exporters, Brazil, Australia, several African economies, who have oriented their production toward Chinese demand, face reduced revenue. Asian manufacturing supply chains that feed Chinese final assembly face reduced orders, and the consumer confidence effects inside China itself reduce domestic demand in a way that compounds the external shock. Thoughtful. Here is what I want you to understand about how these three shocks, oil, Europe, China, interact with each other, because this is the piece that most coverage presents as three separate stories when it is actually one story. In a world where European growth collapses to near zero and Chinese growth falls below 3% simultaneously, global trade volume contracts. When global trade volume contracts, demand for shipping falls. When demand for shipping falls, The commodity exporters who depend on those trade flows face a double hit: lower prices for their exports and lower volumes. Concerned, when commodity exporters face a double hit, their currencies weaken relative to the dollar. When their currencies weaken, the dollar-denominated debt they carry becomes more expensive to service. When debt service costs rise, their domestic fiscal positions deteriorate. And when multiple emerging market economies face fiscal deterioration simultaneously, global financial conditions tighten, which circles back to raise borrowing costs for everyone, including in Europe and the United States. This is not a linear sequence, it is a feedback loop. And feedback loops are precisely what the 6% historical average does not capture, because most of the 20 wars in that dataset did not involve a cascade of this structure. Thoughtful. I am not telling you this to generate alarm. I am telling you this because I think you deserve to have an accurate map of the territory, not a simplified version designed to keep you from asking hard questions. Let me be specific about what the economists are and are not saying, because precision matters here. Chatham House and Capital Economics are not predicting that this scenario is inevitable. They are modeling what the data shows under specific conditions. Specifically, if the conflict continues at its current intensity for an extended period without a negotiated reduction in energy market disruption. That conditionality is important. These are scenario analyses, not forecasts in the St. Richt sense. What they are doing, and this is the part that deserves attention, is telling us what the distribution of outcomes looks like. And the distribution of outcomes under an extended conflict scenario is significantly skewed toward the downside relative to what financial markets are currently pricing. Concerned. When analysts at Capital Economics say Eurozone growth of 0.5% and China below 3%, they are not saying those numbers are certain. They are saying that the probability of outcomes in that range is high enough that it should be reflected in how investors, businesses, and policymakers are positioning themselves. The gap between what those numbers imply and what current market pricing reflects is where the real analytical interest lies. And here is the dimension that almost no mainstream outlet is discussing directly. In a world where Europe slows, China slows, and oil spikes, who controls the narrative about what comes next has enormous economic consequences. If the dominant story becomes one of managed adjustment, temporary disruption, coordinated response, institutions holding, then business and consumer confidence, while damaged, remains intact enough to prevent the feedback loops from becoming self-reinforcing. History shows that confidence is not just a psychological variable. It determines whether the slowdown stays in the economic models or becomes the lived experience of millions of people losing jobs, cutting spending, and triggering the next round of contraction. Size. If the dominant story instead becomes one of systemic fracture, that the institutions coordinating global economic policy are unable to respond effectively, that the energy shock is permanent rather than temporary, that the cascade is already in motion, then the confidence channel amplifies every other mechanism. The same economic conditions produce a much worse outcome because the behavioral responses of firms and households accelerate the deterioration. This is why what economists say publicly matters as much as what they calculate privately. And right now, the institutions whose job it is to model these scenarios are saying something that the public conversation has not yet fully absorbed. Concerned. The policymakers facing this scenario have three broad options, and none of them is comfortable. Pause. The first option is to absorb the shock, allow the economic slowdown to run its course while maintaining the financial and political commitments that define the current order. The cost of this option is measured in growth points, employment figures, and political capital. It preserves institutional credibility but requires populations to accept a period of genuine hardship. The second option is to attempt to offset the shock through fiscal and monetary stimulus, spending more, keeping rates lower, accepting higher inflation in the near term in exchange for supporting economic activity. Thoughtful. The cost of this option is that it risks embedding inflationary expectations at a time when central banks have spent years and significant credibility fighting to bring them down. Once inflation expectations de-anchor, they are historically difficult to re-anchor without a severe tightening that produces the recession you were trying to avoid. Size. The third option is to pursue a negotiated reduction in the conflict's intensity specifically designed to relieve the energy market pressure. This is the option that resolves the economic problem most cleanly, but it involves variables that extend far beyond the economic domain, and the timeline for that kind of resolution is not one that economists can with confidence. The scenario space looks roughly like this, based on the institutional analysis available. In the first scenario, the conflict de-escalates within a short window, energy markets stabilize below $100 per barrel, and the European and Chinese slowdown remains shallow and brief. Global growth takes a modest hit but recovers within 2 to 3 quarters. This is the scenario currently embedded in most market pricing. Curious. In the second scenario, the conflict continues at current intensity for 6 to 12 months. Oil sustains near the Chatham House projection. Europe grows at the capital economics rate of near zero. China falls below 3%. Global trade contracts. Emerging markets face currency and debt pressure. The feedback loops described above activate but do not become self-reinforcing. The outcome is a synchronized global slowdown, painful but not catastrophic, followed by a slow recovery. In the third scenario, the energy shock triggers a confidence collapse. Business and household behavior amplifies the economic deterioration beyond what the models project under rational expectations. A technical global recession, 2 or more consecutive quarters of contraction in global GDP, becomes the baseline rather than the tail risk. Central banks face the impossible choice between fighting inflation and supporting growth simultaneously. Size. In the fourth scenario, a diplomatic development, not necessarily a full resolution but a meaningful reduction in the energy market disruption, arrives earlier than expected. Markets reprice rapidly. The oil shock partly reverses. European and Chinese growth stabilizes at weak but positive levels. The global economy avoids the worst of the cascade. This scenario requires political dynamics that are currently not visible, but it remains within the range of what history shows is possible on timelines that can surprise. Here is what I want to say to you directly, because this is ultimately why any of this matters. Thoughtful. You are watching these events, the headlines about oil prices, the statements from European finance ministers, the quarterly growth revisions from Beijing, and you are trying to form a view of what the world looks like in 6 months, in a year, in 5 years. That is a reasonable thing to be doing. It is what critically thinking adults do when they understand that the world is connected and that what happens far away has consequences close to home. The honest answer is that the timeline of this scenario is genuinely uncertain. Economists and institutions with far more resources than any individual can access are telling us that the downside risks are real, the mechanisms are understood, and the probability of the harder outcomes is higher than the current market pricing implies. Exhales. That is worth knowing. But it is also worth knowing that the outcome is not determined. The scenarios where damage is limited are real scenarios. The institutions that manage global economic coordination, the IMF, the BIS, the major central banks, have demonstrated in the past, most recently after 2008 and during the pandemic, that they can act with speed and scale when the pressure is sufficient. Thoughtful. What you can do with this information is not panic and not sleepwalk. Understand that if you have financial positions, savings, or business decisions that assume the world in 12 months looks like the world 12 months ago, that assumption carries more risk than it did before. And understanding that is the beginning of making better decisions. Not perfect ones, but better ones. Let me bring this together in the clearest terms I can. $130 oil, according to Chatham House. 0.5% Eurozone growth, according to Capital Economics. China below the re%. Curious. These are not predictions of collapse. They are the documented analytical outputs of serious institutions modeling a scenario that is currently unfolding. The cascade mechanism, oil to inflation to central bank constraint to growth compression to trade contraction to emerging market pressure to global financial tightening, is not a theory. It is a sequence that has partial historical precedent and that the institutional economists are mapping explicitly. The coverage gap, the piece that most mainstream financial media is not assembling in one place, is the interaction between these three shocks and the feedback dynamics that can convert a manageable slowdown into something more structurally significant. You now have that picture. Not complete. No picture of an ongoing situation is complete, but accurate in its outlines and honest about its uncertainties. Thoughtful. The question I want to leave in the comments today is this. Of the three regions, oil markets, European economies, or China, which one do you think carries the most underappreciated risk right now? Which one do you think the global conversation is getting the most wrong? Curious. I read every response, and I'll be building future analysis around the patterns I find in your answers.